$10,000. 3 indexes. 30 years. If you had put that money into the Nasdaq in January 1996 and simply never touched it, you would have ended 2025 with $220,935. That is more than double what the S&P 500 would have given you. But here is the part almost nobody mentions. To collect that money, you had to sit through 14 straight years where your investment made no new high at all. Not a dip. 14 years. Start at the beginning. January 1st, 1996. $10,000 goes into each of 3 places. The Dow Jones, 30 large American companies picked by committee. The S&P 500, the 500 biggest, weighted by size. And the Nasdaq, the exchange where the technology companies live. Same money, same day, no trading, no timing, no additions. One rule: you are not allowed to sell. The first 4 years look easy. The Nasdaq gains 22%, then 21%, then 39%, and then in 1999, 85.59% in a single year. By the last day of that year, your $10,000 in the Nasdaq is worth $38,680. The S&P is at $23,855. The Dow, $22,467. The technology bet is winning, and it is not close. This is the peak. You do not know that yet. Then 3 years arrive in a row. 2000, down 39.29%. 2001, down 21.05%. 2002, down 31.53%. Compounded, that is roughly 67% of the Nasdaq gone. By the end of 2002, your Nasdaq money is worth $12,694, which is less than the Dow's $16,300. The best performer of the 1990s is now the worst of the 3. 6 years in, the boring index is ahead. Now comes the part that decides everything. The Nasdaq does not get back to its 1999 level in 2003 or 2007 or 2010. It takes until 2013, 14 years to return to a number it had already reached. 14 years of watching a decision you made look like a mistake. Almost nobody holds through that. And every dollar of the result that follows belongs only to the people who did. From 2013, the Nasdaq runs 43% in 2020, 43% again in 2023. 30 years after that first $10,000, the Dow is worth $93,924, about 7.75% a year. The S&P 500, $111,123, 8.36% a year. The Nasdaq, $220,935, 10.87% a year, 22 times your money. 2 honest notes before you act on any of this. Every number here is a price return. None of it counts dividends, and that quietly favors the Nasdaq because the Dow and the S&P have historically paid more of them. Add dividends back, and the gap narrows meaningfully, and the whole comparison rests on one starting date. Begin in 2000 instead of 1996, and the ranking flips for over a decade. The chart is real. The lesson is not that technology wins. It is that the index that once spent 14 years giving its holders every reason to quit